Thank you, Eloise, and welcome to the guests today for the panel. I'm going to get straight into it, actually, because we've got lots to cover. So if I can come to you, Rob, first, if that's okay. How would you summarise this year, and what are your predictions as we look forward to 2023? And are we now experiencing the new normal for the mortgage market?
Well, it has been a roller coaster of a year, I think would be the best way to describe it. Just when you thought you were getting over one crisis, another one came and smashed you in the face. And it's been really tough for brokers and for lenders trying to cope with the volatility in the market. Are we in a new normal? Well, I think we're in some version of a new normal in terms of the back end of this year, trying to work out what effectively lenders can afford to put on the shelf for brokers to advise to consumers. And you know, I think it's been a positive year to many extents, because we have seen us come out the back end of COVID, which we all thought would be a total disaster, but house price inflation has continued to run at probably an unsustainable level, and therefore taking some steam or heat out of the market might actually be a good place for us to be, particularly as Help to Buy runs out, and therefore the impetus into house price inflation drops back a bit and gives us the capacity to draw breath and think about where we go as we go into 2023 and on into 24. I think also it's probably helpful just to let the issues we were having in conveyancing run their way out, and therefore get back to a state where our pipelines were perhaps not running at 5 to 6 months, and maybe get them back to a much more 3 to 4 month normality, which will take pressure off people. And I think one of the things that I think has characterized the second half of the year is people being under intense personal pressure in their jobs, and to be able to step away from that a little bit during December perhaps, and then have a break and come back into 2023 revitalized, will be really important from a well-being perspective. The challenge, I think, in 2023 is what shape does the market look like? And clearly the purchase market will be less than we've seen for some time, but we've got to remember that the level of maturities coming out of fixed rate mortgages in December this year and all the way through 2023 is a significant number, and therefore I think we'll see a market that's broadly the same size in 23 as in 22, but with a different shape. Purchase will be less, remortgage will be broadly about the same, but product transfers will probably be much bigger. And therefore what we'll have is a market running around the 500 to 520 billion number in total, but a different shape. And therefore I think the challenge for brokers will be, how do they remain relevant to customers in terms of trying to navigate that product transfer and remortgage market? And how do lenders stay relevant to brokers when they've got to think through the kind of pricing they might have to do in order to make that work effectively, and where we're going to see some people in a cost of living crisis, where we've got to think about criteria in a much deeper way.
Brilliant, thank you, Robert. I certainly agree with you with the well-being point, and the fact that it's going to look a bit different next year, albeit the same volumes. It's a bit more refreshing than some of the doom and gloom that we've heard. Nicola, if I can come to you next. Big fan of Lenders Live, by the way, but have you got anything to add to the question?
Yeah, definitely. I think one of the things that Robert said there as well, we see, I mean, this year has been hugely challenging and seemingly more challenging as we've gone on through the year. It started off not too bad, and then of course, let's not even talk about the mini budget, let's not go there. But the one thing that I've seen from brokers is just that overwhelming positivity, and definitely in the face of adversity, but every broker you talk to is sure they've got the down days when they've been out to see a client, the product's been pulled, they're trying to keep up with obviously the conveyancing process. But that overwhelming positivity, I think, is what we'll see brokers through. We're a hardy bunch in this industry, lenders, brokers, and everybody else around the periphery. And I think that's the one thing that will definitely see us through into next year. I think the one thing that I have noticed is we've got some brokers out there who are, I'd say, relatively new to the market. I mean, just old like us that remember 2008 and everything that went on from there. Of course, any of us that were brokers in 2008 onwards, we look at what's going on now and we think, this time next year it'll be fine. That wasn't the case. We're a very, very different scenario. These are external factors that are impacting on our market, whereas 2008 was, kind of self-made, wasn't it? And of course, lenders didn't want to lend. This is a completely different environment. And I think, but this time, everybody's on the same side. Lenders want to lend, brokers want to do their job, they want to advise clients. It's market conditions. So I think, based on that, we've got a really, really good set of circumstances in which to weather this, what I think will be quite a short storm, and I think anybody who's new to the industry, while it must be quite unsettling, I think if you talk to some of the older hands, I think you'll feel a little bit more reassured that this this is this is something that will blow over, definitely.
So a short and shallow recession, dare I say, Nicola, is your prediction for next year?
I'm going to put my cards on the table. I think it is.
Brilliant. And Eloise, how would you summarise this year, and what are your predictions as we sort of look towards next year?
So absolutely, completely echo what Robert and Nicola have said there. The word I would use to summarise this year would be turbulent, to say the least. But we have seemed to come out of, like Robert said, one crisis straight into another repetitively throughout 2022. And absolutely, I think that shows the resilience of both the mortgage industry, but also of everybody that works within it. So it's been a tough year, but we've made some really good tracks. And looking forward to 2023, I think there is some challenge, but with challenge comes opportunity, really. In terms of the new normal, we have probably entered a new phase of the market now, and it's important to remember that when we're looking at house price growth and mortgage volumes, we've seen inflated market volumes over the last 2 years because of, well, largely what's happened with stamp duty and the stamp duty holiday. Currently, as the market stands, swap rates appear to have stabilised and mortgage interest rates seem to be going down. However, this news does appear to have escaped the notice of the mainstream media, which were so keen to comment on our marketplace a few months ago. And that, because of that, the perception of the mortgage industry is still challenged, and this drop in confidence is likely to impact and slow the markets. But that's just in comparison to the last 2 years, which, as I mentioned, has been inflated. So I think it's all about perspective, I would say, at the moment. Rates absolutely won't be as low as what they once were, and customers need to hear that and understand that, but people still need to move home, remortgage, and I do agree that PTs and remortgage will be a big part of next year and what the brokers out there will be seeing.
Thanks, Eloise. So I guess a bit more re-education to, I guess, slightly higher rates, but not disastrous. I'll go on to the next question then, and I'll come to you, Robert, again, if I may. The regulatory landscape is changing too. Every event that I've been to, I think consumer duty has been on the agenda, and it's almost upon us. And vulnerable customers may need more support. Is the market prepared for these changes?
Is the market prepared? Well, not yet, I think, is the answer. But is the market already doing the work that needs to be done? The answer, I think, is yes. I think what we're seeing is a whole host of work going on in major projects in every lender, making sure that they think through what they need to do to be ready for their own processes by the end of July, but certainly for what they have to communicate to brokers by the end of April, in order to make sure that everybody's aware of what goes on. Now, there's a range of things that have to happen in here, fundamental of which is lenders defining what their products are and who they're designed for. Also working out what the service proposition genuinely is and being able to articulate that well. But then what we are trying to do jointly between the UK Finance, the Building Society Association and AMI is produce some form of templates that allow lenders to communicate clearly what the target market for their products is and what fair value for those products looks like. And we're hopeful that we'll have the first draft of those available for consideration by the wider industry before we reach the end of this year. And that hopefully gives us a good starting point, give everybody a good 4 months in order to be able to populate those and communicate effectively in order to make sure that the whole of everybody's ready to be to get to ground zero effectively by end of July. Now, that's not to say there's significant amounts of work still to be done in order to be in the right place around this, and having clarity around what somebody's service proposition is and how they deal with customers in a world where the FCA tells us their reading skills are that of an 11-year-old. And when you really think about that, you have to think through how you put all of the communications you have, whether it's on a website or in writing or verbally, in language that people understand in an easy, straightforward way. And where we do have customers who might be vulnerable, we deal with them in a different way. It doesn't mean you can't deal with them or you shouldn't deal with them. It just means you have to be able to think that through and deal with them in a way that's relevant for them. And I think that's just that challenge. The other big thing that sits as part of the landscape is this new principle of having to avoid causing foreseeable harm. And that causing foreseeable harm concept, I think, applies more to other parts of the financial services landscape than mortgages, because you go back and look at the mortgage sector, an awful lot of the things that we do are already very transparent in that we do produce normally an ESIS that sets out all the key facts in a very simple, straightforward way that consumers should be able to read and understand if not a broker can present. And also we often produce a suitability letter that sets out the rationale for why we've recommended a particular thing for a customer. And in that respect, we're way different to other parts of the landscape. It's also an elongated process where there's a fact find, a delay, then a recommendation, which is very different to what I would call fast point of sale coercion of a customer. And therefore, we're perhaps in a different space to other parts of financial services.
Brilliant, thank you, Robert. Nicola, anything to add?
Yeah, I think this is an interesting one, and you know, I read an article a couple of weeks ago. I think we discussed it on Lenders Live, where I think, you know, quite a worrying number of lenders said they weren't ready for it as well, which is a little bit concerning. And I think actually, if you know, certainly the brokers that I'm speaking to, they're under the impression of, look, you know, I just need to evidence that I'm doing the right thing for the customer. But then is that not a carbon copy of treating customers fairly? Is that, you know, you know, this is something different. And I think it's important to then really identify what are we talking about when we're talking about vulnerable clients. And typically in our industry, when we talk about vulnerable clients, we perhaps talk about the elderly, equity release, that kind of thing. But you've got to really think about what is a vulnerable client, you know, who are vulnerable, and actually do people pass in and out of that that part at different stages of their life? You know, they may be vulnerable for different reasons. I definitely think there is more work to be done. Obviously, the regulator said last week that they're not moving the deadline. It is coming in. So, you know, we have to you know, suck it up and get on with it, and you know, do the best that everybody always does, but really try and help brokers. I mean, lenders have got to do their own thing, and you know, they're much more set up and informed to know what they should be doing. But I do think that you know, we need to try and do everything we can to help brokers really understand what they need to be doing, and you know, if there's anything different they need to be doing, and actually helping them to identify who vulnerable clients really are, and not who they think they are.
Brilliant, thank you, Nicola. It certainly feels, speaking to the networks and clubs, that they're certainly treating this as an opportunity as well. And it's interesting that you mentioned lenders. So Eloise, are we ready for it? And have you got anything from a Kensington perspective?
No, absolutely. So there's like Robert mentioned, there's a lot of work happening on the consumer duty piece, both so I'm part of the IMLA meetings, so the Intermediary Mortgage Lender Association, which means that we're having those conversations with those bodies to try and get a good template put in place. So it's kind of a user-friendly, easy way that absolutely kind of caters to everybody reading that document, so they can have a clear, kind of transparent point of view about what's going on. So there's a lot of work still yet to be done, no doubtedly, but because we've gone through a lot of regulation before, the mortgage industry is very familiar with the regulators. It's put us in a very good position for this. So because we've gone through MMR, because we've got ESIS documents, there is more to be done, but we're in a good position to kind of build on that. Now, particularly from a vulnerable customer perspective, at Kensington, we're doing a lot of work around this, and we really want to promote to our brokers to raise vulnerabilities to us so we can support their customers with any additional needs. So we've created an optional section of our application form. So this can be a really helpful way to facilitate and start that conversation if a broker hasn't had that already, to try and engage with their customers and understand what vulnerabilities they may have. And that can look very different from obvious vulnerabilities like language barriers or learning difficulties to things that are a lot more hidden, and kind of trying to engage with that customer is going to be really, really key to allow you and us to support them better. We've also partnered with the Samaritans, who have trained every single one of our customer services team, again, to better understand and support customers that when they do call us, we know there are a lot of challenges in the marketplace. And as I mentioned, 2023 might have a few more to throw at us. So we want to be in a really good position to be able to cater for those customers and support them in the best way. But definitely that kind of working relationship between lender and broker on sharing that information and making sure we're both on the same page with that is absolutely crucial, so we can do a good job supporting those customers that need it.
Thanks, Eloise. I certainly think it's a good initiative that we've brought the Samaritans on board to sort of train our service staff. Okay, so I'm going to come to Nicola first this time, just sort of given what you do at Knowledge Bank around lenders changing criteria. We're clearly in a very different market now when you look at interest rates, sort of rising inflation and the cost of living increasing. With all these challenges, do you expect to see more customers in need of innovative mortgage solutions?
Definitely, and I think there is still room for innovation. I use that word, and it's quite a broad word, isn't it? It gets banded around a lot. But what genuinely is innovative, and what could we see that's innovative? I think the amount of data that is available now in the market, whether it be the insights data that see what people were searching for, what they came out with, all of that data on customers and how they perform with their credit, property data. It's right for somebody to come along and really shake things up, isn't it, in terms of innovation? But just to contradict myself as well, I look at that and think, hang on a minute. Yes, we're ready for innovation and making customers, really specific products for customers and that kind of thing. However, then you look at the other end of it and think, my goodness, we're still walking in treacle when it comes to conveyancing. So there's a bit of a, how far can we run before we can walk, I guess, is the thing. But I do think that the ground is laid, that the seeds are planted. Innovation, it should be there, but do we need to sort of, tie up some loose ends before we try and run that far? I'm not sure. Possibly.
Thanks, Nicola. And Robert, have we is the room for innovation sort of past the old offset mortgage, which... Do you think there's room for improvement?
Yeah, I think we perhaps need to look at some other things. I mean, we used to have low start mortgages where you paid a lot less at the start, so your interest only converting to capital repayment after a set period of time, which helped people get on the housing ladder, and maybe these might make a comeback. Maybe a little bit more flexibility around certain things. So it's interesting where the Bank of England, effectively, or the Financial Policy Committee, took away the plus 3% stress rate, but very few lenders reacted to that quickly. And the reason they took that away was they recognised that actually we might go into a period where rates were going up, and therefore stressing it free over that revert to rate might not be the right thing in a market that might be going into pressure, because that plus 3 was at a point of low rates, and therefore stressing it was the right place to be, to make sure we're in the right place where we are now with rates are escalating. If we genuinely believe rates may have capped out now, putting in a much lower stress rate above the revert to rate is probably the right thing to do as a counter-cyclical balance in terms of this. Now, lenders need to think about this more than just at the product level. For me, there's a whole load of structures around affordability and criteria that get us to a different place in terms of lending outcome, either the amount that can be borrowed or the affordability around that in terms of looking at incomes. So there's stuff that we can work around there. And also perhaps we need to think a little bit more flexibly around types of property we're prepared to lend against. And that's the other element of this, where we're not always in a line space where we think about the world through our historic lens, not through a future lens. So there's lots of stuff around the edges here. And the product, in terms of what did you lend at what rate, is not all that you need to think about when you really think about this in a dynamic way for me. So lots of opportunity, I think, for lenders to be a little bit more innovative, but I'm not sure product innovation is quite the label that everybody thinks it should be.
Thanks, Robert. Eloise, is there room for innovation in the market?
Absolutely. So it's always a good sign when Robert Sinclair is saying things that you're working on as a lender is ticking the box. Things may come down the line that we're already thinking about. So absolutely, definitely things to watch out for. I absolutely do see the need in the marketplace for innovation. Of course, I am a bit biased, but I think there will definitely be the rise of the specialist customer next year as well. If you think about some of the key sectors that specialist lenders support in, for example, one of them being self-employed, particularly those who are new into self-employment. We know the unemployment rate is currently rising, and if we think back to 15 years ago in the last recession, we saw more people moving into the self-employed sector, either due to redundancies, or this year perhaps it might be customers chasing more ways to make more income to combat the cost of living crisis. We know in the self-employed sector, consumer confidence is lower. Self-employed customers don't believe they can get onto the property ladder. So I think brokers will play a crucial part in that space of supporting them and educating these customers on actually what is available. And probably one of the other spaces I think that may change next year is customers who perhaps have had a credit blip or are looking to consolidate debts. I saw some research from Step Change, the debt advice charity. They'd released some findings that every month this year they'd had an increase, more and more customers saying to them they've taken on more debt just to keep up with the cost of living crisis or with their current lifestyle. So combining that information with the knowledge that we're at a 40-year high in terms of inflation, real wages are falling, and as I mentioned, unemployment rates are expected to and have already started to rise, I think we may start to see more customers needing specialist solutions and more common sense approach. So particularly with the financial pressures of Christmas coming up and the energy price changes coming in early next year. So yes, I think we will see more challenges, also with affordability and supporting more customers onto the property ladder, like Robert mentioned, with the end of Help to Buy coming up. There's a lot more kind of new schemes and conversations that lenders need to be having behind doors to really get to the grips of what customers need to support them onto the property ladder and how to let brokers say yes to more of those customers and kind of support that growth again.
Thanks, Eloise. And naturally, I would completely agree with your rise in specialist customer sentiment. And finally, if I come to you, Rob, with this one first, with the changing landscape, which we've discussed, what should brokers be focusing on right now? And what sort of top tips would you give them to ensure that 2023 is a successful year?
Well, first of all, I think is making sure you're managing out the pipeline you've got, being really aware of when offers might be expiring or what delays there are with solicitors in order to make sure that there aren't any issues as that chain does or does not complete. That's the first thing that is really, really important at the moment. So knowing that pipeline really well and making sure that 2 weeks before that offer expires, you're actually shaking the tree and making sure people get finished what needs to be finished. The next part is really having a plan to deal with your existing customers in terms of their product expiry and renewal. That's the second piece in terms of strategy and structure. The third one is, and I'm going to say it's a phrase I don't like, but the best one is don't leave money on the table. There needs to be good discussions with people about what it is they can afford and not afford at this point in time. A lot of people want to have a discussion with a broker or with their lender about how do they get help. Those discussions need to be very focused about what they need to have and what they can afford. And people need protection at a time like this more than they think. So buying the right insurance policies, keeping the right insurance policies, having dialogue about why it's important to keep those is really, really critical at this point. And if people are still in work and still not in a position of being in difficulty, getting the right protection behind them is now the right time to do that, rather than the time to think, well, I can't afford this. Because why can you afford not to protect the one piece of resource that keeps you in your home and putting food on the table? It's ridiculous that people can have that debate, in my view. So those are the things for me that good brokers should be doing, and really thinking about a comms plan with their customers for the next period of time and making sure that they pick up the phone and speak to them regularly, because the customer will appreciate that more further down the line, to know that they've got somebody on their side as they go through what will be difficult times for all of us, I think, over the next 12 months.
Yeah, brilliant. Thanks, Rob. Some really good insights there. Nicola, if we can come to you next, what top tips would you give the brokers watching today?
I was listening to what Rob was saying there, and I was stealing my thought. I think that's exactly what I do. Exactly, thinking back to when I was a broker, and I think the number one top tip is absolutely contact strategy. What is your contact strategy for your customers? Keeping in touch with them. Even if you're getting in touch with them to not talk about mortgages or protection, you're still reaching out to them, helpful tips on saving money or just something that's relevant to what's going on now. They are going to appreciate that. And the one thing that I always used to say when I was a broker and I used to run a brokerage is do not ignore general insurance. It is the backbone of your brokerage. Don't just let it sit there and renew. Every single time, rebroke that. And let's be honest, if you're not doing the volumes of mortgages, you have absolutely got time to do that. So if you are reaching out to your customers, you're getting a better deal, you're going to get referrals off the back of that. It's just such an underutilized part of business, the home insurance side, that I think, you can really, really strategize that then. And obviously that leads on to other conversations about mortgages, referrals, protection. So I think contact strategy, and just don't ignore the smaller protection side of the business, because I think that can really reap rewards. And of course, you know, if you get that right, if you nail that contact strategy, the good thing is when it does start getting busier, you are that broker that they want to come and see and they want to recommend. So you've sown those seeds, and you know, as soon as the market's back and people are moving homes again, which, let's be honest, you know, it could be as early as after Christmas. You know, we are in where we are now. Yes, of course, the market, we know what's happening there, but let's not forget there's always a natural dip, isn't there, towards the back end of the year into Christmas. So let's see what happens next year, but use this time to really get your house in order, get that contact strategy right, and you know, don't ignore the little stuff, would be my advice.
Thanks, Nicola. Yeah, really good point around GI. I guess it's an annual touch point, and I guess brokers will be looking at exit strategies, so it just adds a bit more value to the business. Last but not least, with the last word, Eloise, what top tips would you give the brokers listening today?
So in the spirit of being different, because absolutely I agree with Nicola, both Roberts has stolen our thunder there. I think it's definitely a key strategy going forward, understanding your client bank, and definitely PT will be a big part of that. So knowing which lenders are in that space will be key. But I'll say maybe a big focus for next year is continue to stay educated, do what you're doing today, come onto sessions like this. There's a lot of changes that are expected next year from consumer duty, the green agenda. There's a lot to keep an eye on. So absolutely engage, stay close would probably be my top tip as well, actually. There's a lot going on in the industry, and we are as keen as ever to do business. We are as keen to lend, to continue to innovate and grow and find ways to make the most out of the market that we're in. So absolutely reach out to your Kensington BDM. They have fantastic access to data. Talk to Nicola with Knowledge Bank. There's such useful tools out there to keep you well informed. So absolutely, I would say, yeah, stay close. We want to stay close to you, and yeah, here's to 2023, really, I suppose.
Adam, I'm going to come back with one more thing. One thing that came out, some research I saw the other day. One thing that mortgage brokers are not good at is asking at the end of when they've done the work with the customers, is the customer happy with what we've done for them? But also then ask for the follow-up question, which is, and if you're happy with what I've done for you, is there somebody you think you could benefit from my services? Not enough brokers are brave enough to ask that question. And if they did, they would grow their business geometrically over time. And I think they just have to be a bit more prepared to sometimes accept well, actually, I didn't think you did that bit well. And that's a great learning tool if you actually think about consumer duty. But also then for the ones that say yes, if they genuinely do believe it, they will find somebody else for you to service. Yeah,
brilliant point to end, I think. I guess all that's left is just for me to say thank you to the panelists and for everyone watching. So thank you, Robert, Nicola, for your insights, and indeed Eloise. Yeah, thank you, everybody.